The stock of the day is brought to you by IG, Australia's #1 CFD provider. With over 17,000 markets and extended trading hours, turn US earnings season volatility into opportunity. Get started at IG.com.
I'm Nadine Blaney from ausbiz, and for our stock of the day, I thought, why not celebrate the start of a new financial year? And to do so, I thought I'd ask my guests, Pepe from Shaw & Partners and Rudi Filapek van Dijk from FNArena, what stocks they would be buying for FY26. I'll start with you, Pepe. We've still in your thunder, put them up on screen. Why Westpac?
Why Westpac? Because I think analysts are just too pessimistic on the banking sector. My view, if you look at the historical data, interest rate reductions, sustained interest rate reductions, tend to result in high credit growth, and we saw a good print yesterday from APRA in terms of credit growth for May, and that tends to drive up bank share prices, just because volumes are growing. That's easier to increase your profits, and it tends to push share prices up. Now, most analysts have pedestrian growth forecasts for the banks, and maybe that's fair enough. But Westpac, which most people think have it as a neutral, it's lagging behind the others in terms of return on capital. It's at about 10%. The others are at 12%. CBA, I think, is at 14% off the top of my head. So they have a 3-year strategic plan to catch up to their peers with a cost out or minimise cost increase strategy over the next 3 years. And if they can get their return on equity from 10% to 12%, that's a major re-rate just to catch up to the other banks. Nobody's forecasting that other than, I think, UBS. Most of the analysts are saying it can't be done. So if they can prove the market wrong in an environment where interest rates are falling and credit growth volumes are going up, I think they've got a tailwind. Contrarian view, but it's a large cap. I actually think will do well in FY26 for that reason.
And you've spoiled us, haven't you? You've given us a small cap pick as well.
Well, you put up on the screen. So yeah, look, and I'm a small caps analyst, so I have to do a small cap. So that was a contrarian view.
Okay.
My next one's a momentum view. SRG Global. It's been up over 100% for the financial year. Yes, I cover it, got to buy it, yay. Very much momentum behind them. Strong tailwinds. They're an asset maintenance, infrastructure maintenance provider. Over the financial year 2025, they won over 1.8 billion in contracts, up from 780 the year before. It's a bigger business now literally adding billions of dollars of work over multiple years. Their tenders and pipelines is probably 6 to 7 billion now. Major strong tailwind in their back. It's had the re-rate. It was once massively cheap versus its peers. Now it's not placed about on average, maybe slightly above average versus its peers. But market leader Monadelphius has about a 3 or 4 PE point premium versus SRG. As SRG continues to win new friends and perhaps closes in on ASX 200 index inclusion, it'll win more friends and hopefully generate another solid share price return over the next 12 months.
So still upside for SRG after that run. Nice. Rudi Filapek van Dijk from FNArena is sitting here as well. You can comment on either one of those stocks, or you can give us your FY26 buy.
Well, it's a brave call on Westpac. That's all I'm going to say. I couldn't help but noticing UBS recently put out a report, and they must have get a lot of questions about the banks. And their view, which I completely subscribe to as well, is that if you think that CBA is too expensive today, what will probably bring CBA undone at some point is not something CBA specific, but it will go for the whole sector as a whole. So the time that CBA will fall by $10, $20 in share price, you will not be able to hide in ANZ, in Westpac, and in NAB. And just throwing that one in for investors who think that if by picking the cheaper bank that you will get protection. And I do think at some point the market will find a way of, not while tariffs are on, but at some point the market will find a way of derating that sector, at the very least a little bit.
Let's get to your good news.
Let's get to my good news. I'm actually going to nominate a theme.
Okay.
Typically in the way markets operate, last year, 2024, investors might have got a little bit too excited about AI. I think AI is here to stay. Come January, February, all of a sudden AI had to be sold down. So all the share prices today are lower than where they were. And I think they still, if you believe that AI is something that will define the next decade, not just the next year, then a lot of those stocks, they are absolutely worth considering. Now, I personally own NextDC, Goodman Group, Macquarie Technology, and Dikke Data, and they're all directly AI related. But you can also form an argument that companies like WiseTech, even Telstra, and others will increasingly become AI stocks because it'll be applied across the business. If I had to nominate a favorite right now, it would be NextDC. But there are others. There is a REIT, the Digital Infrastructure REIT, which has been listed, and there are some other companies that have access. But I would encourage investors to look through market hype and sentiment, and to get positioned for AI, because AI is going to stick around for much longer.
There you go. Spoiled for choice today from my expert guest, Rudi, Filapek, Van Dijk, FNArena, Philip Pepe from Shaw & Partners. Thank you to you both. That was Westpac, SRG Global, and the AI thematic. Rudi's got NextDC, GMG, MAQ, and DDR in his portfolio. Stay with us.
The stock of the day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.